Imagine looking at a corporate balance sheet and realizing the company didn't just, beat Wall Street estimates. I mean, their quarterly revenue surged 407% year over year.
Right, which is just a staggering number.
Yeah, it's wild. And in a single year, their total assets swelled from under $2 billion to nearly $10 billion. So today's deep dive is on Applied Digital Corporation.
Ticker APLD, right?
Exactly, APLD. And they are sitting right at this chaotic intersection of the massive AI infrastructure boom and a severe global scarcity of data center capacity.
Yeah, it's a huge bottleneck right now.
Right. So we are digging into the data as of August 21st, 2026. And our core mission for you today is to figure out if APLD is, well, the ultimate high-conviction AI infrastructure play, or if it's a high-risk debt trap just waiting to spring on unsuspecting investors.
To really grasp the sheer scale of what's happening with APLD, you kind of have to completely shift your perspective. Like when most people hear artificial intelligence, they immediately think of software.
Sure, algorithms, ChatGPT, that kind of stuff.
Exactly. They think of large language models, code floating in the ether. But Applied Digital is fundamentally a real estate and power infrastructure story.
The physical stuff.
Right, the physical stuff. While the market is totally mesmerized by the software layer, the physical constraints, the literal permitted land, the thousands of tons of poured concrete, the gigawatts of electricity you need to run these models, that's where the real hard bottlenecks exist.
I mean, you can't run the code without the power.
You really can't. And frankly, that physical choke point is where the generational fortunes are being made right now.
And that physical constraint is clearly driving a rocket ship trajectory on their top line. I mean, looking at the numbers, their fiscal year 2026 ended on May 31st, and the full year revenue hit $611.3 million. Yeah, that's up 167% from the previous year, which sat at $228.6 million.
Which was already a jump.
Right, because the year before that was just $165.6 million. And then you look at their most recent quarterly numbers, they hit over $258 million in a single quarter.
Giving us that 400% quarterly growth metric.
Exactly.
The velocity of that revenue growth, it's a direct reflection of broader, massive industry tailwinds. We are watching the rapid, real-time evolution of what analysts are calling the neo-cloud ecosystem.
Neo-cloud, I like that.
Yeah, it's a great term. Because traditional legacy cloud providers, the companies that kind of dominated the last decade, they were built for general purpose computing.
Like hosting websites, enterprise databases, that kind of normal IT workload.
Exactly. But AI workloads are fundamentally different. They require a completely different physical architecture. They need incredibly high-density server racks, highly specialized liquid cooling systems, and just an astronomical amount of power drawn into a single concentrated footprint.
So the legacy data centers just aren't wired for it?
They aren't wired or cooled to handle it, no.
Yeah. It kind of feels like everyone spent the last 10 years building marinas for speedboats, and suddenly the market only wants to buy massive supertankers.
Oh, that's a perfect way to visualize it.
Right, and the old docks just don't work for supertankers. So you have these specialized AI-native infrastructure companies stepping in to build the deep water ports.
Yep, and the capital flowing into these deep water ports is just unprecedented. I mean, our sources highlight that NVIDIA is reportedly spearheading a $500 billion compute financing platform to accelerate this build-out.
$500 billion? That is insane.
It is. And you look at APLD's direct competitors, like CoreWeave, who just doubled their own revenue. Wall Street is so focused on this shift that there are even dedicated financial instruments launching, like the Roundhill NeoCloud ETF.
Oh, specifically designed to track this subset of infrastructure providers.
Exactly.
So the macro environment is clearly throwing fuel on the fire. But, I mean, revenue growth alone doesn't mean you win the market.
Right.
Especially when the market is this lucrative, right?
Definitely not.
Because if I look at the competitive landscape, peers like Iron are already ranked #1 in AI monetization efficiency. They are squeezing out $40 million per megawatt.
Which is a huge number.
Right. So if competitors are already operating with that level of extreme efficiency, APLD isn't just competing for land. I mean, they have to compete on the operational yield of every single watt of power they secure.
Yeah, efficiency leadership from peers like Iron absolutely sets a brutal benchmark. It proves that simply, Acquiring the real estate and the transformers isn't enough to dominate.
You actually have to monetize it.
You have to monetize the infrastructure ruthlessly well. APLD has to demonstrate that their facility design and their server deployment can match or beat that $40 million per megawatt threshold.
Or else what?
Well, otherwise, their massive top-line growth could just be masking underlying operational inefficiencies.
Right, which makes securing guaranteed long-term revenue incredibly crucial before they spend billions building these super dense facilities.
Absolutely.
And our sources reveal APLD has reported a backlog of approximately $36 billion in multi-decade contracted leases.
$36 billion.
Yeah, $36 billion. And that massive pipeline is heavily tied to their strategic partnership with CoreWeave.
And this is where we see the real manifestation of the power infrastructure moat. Because in this global AI arms race, possessing the world's most advanced compute chips is, well, it's useless if you don't have the physical electrical grid capacity to turn them on.
You just have expensive paperweights.
Exactly. Securing interconnection agreements with utility companies, getting the environmental permits, physically routing transmission lines, all of that takes years.
So it's a huge barrier to entry.
It's an insurmountable barrier to entry for latecomers right now. So that $36 billion backlog, that represents multi-year revenue visibility.
Basically saying companies like CoreWeave are so desperate to guarantee their own future capacity, they'll sign binding long-term leases today.
For facilities that haven't even been fully built yet.
Okay, but wait, let's inject some reality into this multi-decade lease concept. If you're listening to this and you follow tech, you know, AI hardware architectures change practically every 6 months.
Very true.
We have new generations of chips, entirely new networking topologies, constantly shifting cooling requirements. How can any sane company confidently sign a 20-year lease for AI infrastructure?
It sounds crazy, right?
Yeah. What if the physical hardware needs completely pivot in 3 years? Aren't they locking themselves into obsolete buildings?
It's the ultimate counterintuitive move until you realize what they are actually leasing. CoreWeave and the others aren't necessarily locking in a specific technological layout.
Yeah, they are.
No, they're locking in the raw demand for pure electrical capacity and the physical conditioned space. The underlying requirement, like the massive concrete slabs that can support thousands of pounds per square foot, the dedicated high-voltage utility substations, that baseline physical foundation remains relatively constant.
So it doesn't matter what chip is in there.
Right. Regardless of whether you are plugging in an NVIDIA GPU today or some wild quantum neural architecture 10 years from now, that hardware will demand an immense amount of power and sophisticated thermal management. APLD is securing the ultimate scarce resource.
The megawatt itself.
Exactly. The megawatt itself.
So they are basically providing the specialized high-voltage socket. Whatever plug the client wants to use over the next 20 years is up to them as long as they keep paying for access to the socket.
That's a great way to look at it.
It's brilliant in theory, but, you know, theory hits a brick wall when you look at the balance sheet. Building these next-generation data centers requires staggering amounts of upfront cash.
Huge amounts.
And it's creating a very dangerous profitability paradox for APLD.
Yeah, the financials are where the narrative tension really peaks for this company. You have these phenomenal top-line revenue numbers, but the capital expenditure required to generate that revenue is astronomical.
So let's break down that contradiction. On the positive side, APLD hit a massive milestone in fiscal year 2026. Their operating cash flow finally turned positive, hitting $89.7 million.
Which is great news.
It's a massive, highly encouraging reversal from a negative operating cash flow of $115.4 million just the year prior.
Right, it shows the core business works.
Exactly. The day-to-day business of leasing space is finally throwing off cash. But the net income paints a completely different, frankly terrifying picture.
Uh-oh.
Yeah, despite tripling their revenue, APLD still posted a net loss of $184.3 million for the year.
Ouch. I mean, transitioning to positive operating cash flow is the first crucial step for any infrastructure play. You know, it proves the fundamental unit economics work on a daily basis.
Right.
But that $184 million net loss really highlights the crushing gravity of their capital expenditures and their interest burdens. To really digest the risk, you have to zero in on the balance sheet transformation.
What did that look like?
Over the course of just one single year, APLD's total assets jumped from under $2 billion to $9.9 $9 billion.
A five-fold increase in total assets in 12 months.
Exactly.
I mean, they're buying land, securing massive transformers, ordering cooling towers, and just building out the physical footprint at a breakneck pace.
But those assets weren't bought with cash from operations.
Oh, right.
Total liabilities surged aggressively right alongside them. Liabilities skyrocketed from $1.2 billion to $6.16 billion.
Wow. Over $6 billion liabilities.
Yeah. And when you stack that mountain of debt against just $7 billion in stockholder equity, you are looking at a liability to equity ratio of roughly 3.6 times.
That is incredibly high leverage.
Extremely high.
It is basically the corporate equivalent of taking out a massive high-interest mega mortgage to flip a sprawling, dilapidated mansion.
That's spot on.
Like, if the local housing market stays red hot and you finish all the expensive renovations on time and under budget, you look like an absolute genius. You sell the mansion, pay off the massive mortgage, and pocket a fortune.
Right, but if things go wrong...
Exactly. If you hit unexpected construction delays, or if the cost of raw materials suddenly spikes, the compounding interest on that massive mortgage just eats you alive before you ever get a chance to sell.
That analogy perfectly captures the binary outcome APLD is facing. And to make matters far more difficult for anyone trying to analyze the true risk here, there is a glaring, frustrating gap in the available financial data.
What's missing?
The exact composition of that $6.186 billion in liabilities isn't fully detailed in the SEC filings provided in our research.
Wait, a $6 billion liability black box?
Pretty much.
In standard commercial real estate, you would at least see a clear multi-year schedule of debt maturities. We need to know when these specific project financing loans come due.
Yep, and without that...
If we don't know the exact interest rates on these various instruments or the timeline for repayment, we can't accurately calculate if their newly positive operating cash flow even comes close to covering the debt servicing costs.
Precisely. I mean, we can safely assume that $6 billion includes significant lease obligations, massive project-level financing for the new data centers, and various complex debt instruments necessary to fund a build-out of this magnitude.
Sure, it takes a lot of different loans.
But without a granular breakdown of current debt maturities, the specific interest rate covenants, or any off-balance sheet commitments, it is incredibly difficult to calculate a true free cash flow proxy.
So you can't really gauge their liquidity runway.
It makes it nearly impossible. It's a massive blind spot right where investors desperately need the most transparency.
Which tells me Wall Street is probably pricing in a heavy risk premium. So we have explosive revenue growth clashing head-on with a highly leveraged balance sheet and a $6 billion blind spot.
It's quite the mix.
Let's look at the actual market mechanics then. As of August 21st, 2026, APLD is trading at $28.65. But despite that jaw-dropping 400% quarterly revenue surge we talked about at the top of the show, the stock is actually down 21.7% over the last 13 weeks.
That's a huge disconnect.
Right. It is broken down below both its 50-day and 200-day moving averages.
It is a textbook brutal divergence between top-line fundamental momentum and actual market sentiment. The market is looking at the revenue growth and saying, we see it, but we are terrified of what it's costing you to get it.
Yeah, that makes sense.
And when you unpack the specific sentiment data, you see a massive tug of war between the analysts modeling the future and the insiders dealing with the present.
Okay, break that down for me.
Well, on one side, the analyst community seems quite optimistic. The consensus average price target currently sits at $68.15, with a general moderate buy rating.
Okay, pretty bullish.
Though I will note, Morgan Stanley is playing it much more cautiously. They initiated an equal weight rating with a target of just $37.50, clearly reflecting some of these balance sheet concerns.
Right. Analysts are modeling out the $36 billion backlog and seeing massive future cash flows. But what about the people actually inside the building? The executives who know exactly what is inside that $6 billion liability black box.
That is where the narrative takes a dark turn.
Oh, boy.
The insider activity sharply contradicts the rosy analyst projections. The monthly sentiment purchasing ratio, which tracks the ratio of insider buying to insider selling, is extremely negative right now.
How negative?
Recent filings show insiders have sold roughly 75,000 shares, and there have been absolute zero open market purchases by executives or directors.
Okay, that's a red flag. If the underlying fundamentals are supposedly improving, if operating cash flow just officially turned positive, and they're sitting on $36 billion in guaranteed future revenue. Why is the stock steadily pulling back, and why are the insiders cashing out?
It's a very valid question.
What does the open market know that the 400% revenue beat isn't showing us?
The market is ruthlessly pricing in two highly probable negative outcomes: severe execution risk and the looming threat of massive shareholder dilution.
Dilution. Right,
Yes,
right.
the backlog is huge, but as we discussed, it costs billions of real dollars today to build out the physical facilities to service that future backlog.
Cash they don't necessarily have on hand.
Exactly.
Oh.
If APLD burns through its current cash reserves before those data centers are finished and generating revenue, or, if they hit significant supply chain delays for critical components like cooling units or transformers, how do they bridge the cash shortfall?
Well, they either take on even more expensive, punitive debt, or they are forced to issue millions of new shares of stock to raise capital.
And if they issue more stock, the current shareholders get severely diluted. Their piece of the pie shrinks. So while the insider selling could simply be routine profit-taking or tax loss harvesting, when you place those sales against the backdrop of a highly leveraged balance sheet and billions in upcoming capital expenditures, the market interprets it as a glaring lack of confidence.
Investors fear the executives don't believe they can get across the finish line without diluting the equity.
Exactly.
It is just a high-wire act being performed without a safety net. And APLD carries a wildly high beta of 6.07.
Which is huge.
For a stock to be 6 times more volatile than the broader market is extraordinary. It means any piece of news, good or bad, is going to cause violent swings in the share price.
Without a doubt.
Because it's this sensitive, we have to map out the extreme ends of the spectrum for you. Let's look at the blue sky scenario first. What does the fundamental picture look like if management flawlessly pulls this off over the next 2 to 5 years?
So in a true optimistic blue sky path, APLD executes its facility build-outs without a single major hitch. They perfectly navigate the treacherous supply chain, they secure all necessary utility power procurement on time, and they avoid any cost overruns.
A perfect execution.
Right. And as they finish construction, they begin monetizing that $36 billion backlog at full scale. Currently, their gross margin is sitting at 22.38%.
Okay.
As these massive new facilities reach stabilized, mature operations, we would expect to see that gross margin expand significantly, marching up toward the 30 to 40% range that is standard for established, mature data center operators.
And when gross margins double on billions of dollars in revenue, the magic of operating leverage finally kicks in.
It really does.
The massive fixed costs of the buildings and the debt are covered, meaning almost every new dollar of revenue disproportionately drops straight to the bottom line as pure profit.
And if they achieve that margin expansion, the stock fundamentally re-rates.
It completely shifts categories.
It does. It transitions from being viewed as a speculative, highly leveraged growth play valued purely on a revenue multiple to a stable, highly profitable utility valued on an earnings-based framework.
That's the dream.
In that scenario, APLD becomes a foundational, cash-generating utility for the AI age, and the current debt load looks like a brilliant, temporary bridge to a massive moat.
But the path to becoming a cash-generating utility is littered with landmines. We have to map out the thesis breakers, too. What specific events shatter that blue sky dream and trigger a collapse?
The single biggest existential threat is poor execution on these large-scale construction builds.
The actual building of the centers.
Yes. Building a 100-megawatt liquid-cooled data center is incredibly complex engineering. Any 8K filings that hit the wire announcing construction delays, severe cost overruns, or most critically delays in utility companies delivering promised grid power would be disastrous.
Because the clock is ticking on the debt.
Exactly. A delay means the revenue gets pushed further into the future, but the interest payments on that $6 billion in debt continue to compound right now.
And that leads directly to the dilution death spiral.
It really does.
If revenue growth decelerates or stalls out before they reach sustainable net profitability, that mountain of debt becomes entirely unsustainable. They are forced to the equity markets from a position of weakness, issuing massive amounts of stock at depressed prices, which just crushes the value of the shares held by investors today.
That is the ultimate bear case. The fundamentals absolutely have to outrun the debt payments.
So, synthesizing this entire deep dive for you, Applied Digital is a hyper-growth, high-reward, high-risk vehicle to play the physical, concrete, and steel side of the artificial intelligence boom.
That's a good summary.
You are balancing a tripling of annual revenue, a massive multi-decade backlog, and overwhelming industry tailwinds against a sheer mountain of murky liabilities, negative net income, and the brutal, unforgiving realities of large-scale construction execution.
So for anyone actively following this space or considering a position, there are very specific milestones you must monitor.
What should they look out for?
First, watch the upcoming Q1 fiscal year 2027 earnings report. You need to verify if they can actually sustain that $250 million plus quarterly revenue run rate, or if that was just an anomaly.
That's crucial.
Second, ruthlessly scrutinize every single facility milestone update, or SEC filing, for even the slightest hint of construction or power procurement delays. And most importantly, track the gross margin.
Right, because of the operating leverage.
Exactly. Evidence of gross margin expansion is the only clear, undeniable signal that they are successfully transitioning from a company that burns cash to build things into a company that generates profit from operating things.
Extreme physical scale colliding with extreme financial leverage. Before we wrap up, I want you to step back and ponder a broader question, zooming out from just APLD.
Okay, let's hear it.
Let's assume AI compute power eventually becomes a standardized, commoditized public utility over the next decade, much like electricity or municipal water is today.
Which is very likely.
What happens to these early, aggressive infrastructure pioneers who are currently carrying billions in high-interest debt to build the very first generation of these facilities? Do they successfully solidify their $36 billion moats and become the untouchable, highly regulated utility monopolies of the 21st century?
Huh.
Or, once the initial desperate gold rush for capacity is over, do their margins get entirely crushed by a second wave of cheaper, newer competitors who didn't have to take on $6 billion of expensive debt to clear the jungle and build the first roads?
It is the defining question of every major technological infrastructure build-out in history. The classic pioneer's dilemma. Do you get the gold or do you get the arrows?
An incredibly high-stakes dilemma to keep in mind the next time you see a 400% revenue beat flashing in the headlines. Thanks for joining us on this deep dive. We'll catch you next time.